Welcome to the 2022 Janus Henderson Global Media Conference. I'm Geraldine Walsh, Head of Asia Pacific Marketing, and this panel is going to discuss Asian equities. We've assembled an expert panel today who will give their outlook. They are Ling, a portfolio manager who covers Chinese equities, Sat Duhra, who co-manages Janus Henderson Asian Dividend Income Strategy, and our Head of Japanese Equities, Junichi Inoue. With that, let's kick off with our first question for the panel. Still very much top of mind, can you give us an update on COVID's impact on your regions? Omicron has yet to really hit Asia in comparison to the West. How is this playing out in terms of GDP growth and domestic demand and supply chains? Have the markets and your expectations changed much this year? Ling, maybe you can start with us off with your views on China's COVID policy.
Yeah, I think with China's COVID policy, it still remains the same of local containments, containing COVID cases as close to zero as possible. The local authorities have staked their claim to fame almost to zero COVID, and they've managed to contain COVID very quickly. But we expect these restrictions to stay in place through 2022 because we don't expect COVID to go away quickly. So in terms of the impact on the economy, it's definitely impacted consumption in China, where we've had on-off restrictions, which have prevented consumption, especially in services, to recover to the levels that they were pre-COVID. So that's impacted a good part of the economy. It hasn't quite come back. In terms of supply chains in China, COVID has impacted production to a much smaller extent because the priority for the government is really to ensure that supply chains, production and factories, industrial production is running as well. So the impact is less on the industrial sector, more on the consumer sector, and it remains the case last year. And we see the same thing happening this year as well in terms of COVID's impact on China. As to when China opens, we still think it will stay with close to zero COVID, definitely to the Beijing Olympics in February. It's possible that they stay with the same policy to the Party Congress in October 2022. But if there was a breakthrough, if China was successful in its own mRNA vaccine or its own COVID drug, it is possible the economy, 1.4 billion people, could open a bit earlier to the global economies as well.
Thank you, Ling. Sat, some countries are reopening their economies faster than others, or stopping the reopening in response to the latest outbreaks. How is this affecting your decisions and ultimately portfolio performance and decisions?
Yeah, it's been quite a mixed experience really in Asia because, of course, initially the sectors that you would have expected to be impacted, so airlines, leisure, the more consumer discretionary subsectors, were obviously impacted. But even from a value and more defensive strategy, we were still impacted by the impact on, for example, REITs and telcos, which you probably would not have expected. But because of the pressure on tenants, footfall falling and so on, and rental outlook much weaker, REITs are quite severely impacted. And it's only after support from governments that they decided to look more investable. And then, of course, telcos as well, you had the issue of roaming revenue coming off as well. So it really hit every kind of strategy, so value and growth in many ways. Of course, towards the second half of the year, there was quite a big change. So when you saw the announcement of the vaccine towards the end of 2020, then there were a whole bunch of under-owned sectors. And I would say that would be financials, that would be the likes of materials and energy. And then they worked very well after that. And even up to now, and beginning of this year, they've worked well. So there are some good fundamental reasons for liking those sectors. And I think that in terms of positioning now, to answer your question, I would say that they still look attractive. Now, firstly, in an inflationary environment, those sectors actually do well. But there are more fundamental reasons. And I would say, if you look at financials, there is, the dividend's been restored. For example, in Singapore, Australia, they look good. But there's a very strong margin story as well. In this environment, investors are looking for areas where how can they protect their portfolio against inflation and how do they become beneficiaries of rising rates? And financials is probably the best answer you can find. And so margin outlook is a lot better. We have areas such as Singapore banks, Hong Kong, Taiwanese banks, that will be beneficiaries of rising rates. So there is some structural argument there in terms of the the operational performance, margins, and so on. And provisions are being written back as well. Dividends look good. And then on materials, there's been a strong rebound in demand, and supply is also quite tight, partly because of ESG factors. So it does take longer to open, for example, a copper mine. The demand from EVs for metals is obviously very strong. So a number I always quote is, which I still find quite fascinating, is electric vehicle uses about 80 kilograms of copper. And an internal combustion engine would be using, I think, 25, 30 kilograms. I mean, that's a huge difference. So you can see where the demand is coming from in some of these material sectors as well. So, that's what I would say. I would say that's where we're positioned now, and that's what I find attractive at this point.
Thank you, Sat. Moving on to Junichi, turning our focus to Japan. Can you comment on the current travel bans, the impact that has on domestic demand and market sentiment from your perspective?
Okay, yes. So Q4 last year, we really enjoyed a short period of reopenings, and the number of COVID new cases in Tokyo was as low as double digit. So economy was quite good in Q4, but since the beginning of this year, Omicron virus is spreading quite fast. So that is impacting on the decisions. So foreigners at the moment, since December, is not allowed to visit Japan unless they are resident or have a family here. So anything to do with inbound tourism, such as Shiseido Cosmetics and Niseko Skiing Resort, will continue to suffer. So for very short term, the sentiment is not good, and business and people's daily life is being impacted. So if you compare Q-on-Q basis, then that's a clearly negative factor. And I'm expecting that we could have another drop in terms of GDP in Q1. However, as far as the market is concerned, we are quite accustomed to this. And also, these sectors impacted by COVID is quite small relative to the total index. And what matters more is a global demand and also input price and foreign demand level, and also the current exchange rate, which is been sending a mixed signals, but companies are managing, as far as the companies I own, they are managing this very well. So I guess quite negative on people's daily life, but not so much for the companies or stock market is concerned.
Thank you. And Sat, you had touched briefly on inflation in your first question, but we can't get away without talking about inflation in more depth than interest rates. Expectations are that we will still see a divergence in monetary policy in Asia, with inflation being troublesome for the more developed economies, while the more emerging ones will be prioritizing their growth agendas. What are you seeing in your markets now? And how are sectors and companies dealing with inflationary pressures and rising input costs? And in addition, all eyes will be on this week's FOMC meeting, the first of the year, with the all-important rate decision and trajectory for tightening. Junichi, would you like to kick off on this question first?
Okay, yeah. So we have been suffering for decades on a deflation. So any number in positive territory seems good. And the latest CPI number in December was 0.5% plus. But excluding the phone tariff impact, which was substantially cut last year, the actual figure is more like 2%. And this is, BOJ has been targeting for years. And the corporate margin has been compressed, but we are hearing the news about price hike here and there. So there is some expectations that we may see higher number this year, which would eventually change the central bank's policy. So the change in a negative interest policy or yield curve control this year. The Governor Kuroda, his term is until spring of next year. So this is also suggesting that there is some potential for policy change. On the government side, PM Kishida is now trying very hard to increase wages in order to create a positive cycle from wage increase and price increase. And however, the market is only paying attention to the negative side. So I do think that there is some opportunities that the regime of a deflation is really changing in Japan.
Great, thank you. Seth, what's your insight here? Perhaps like contrasting some of the bigger markets, India, South Korea, with the smaller and also important markets, as well as Asia ex-Japan as a whole.
Yeah, it's interesting you mention India and South Korea, because actually I would say it's less about the larger markets and the smaller markets, but the divergence between North Asia, so likes of Korea, Taiwan, China, and South Asia, so India, Indonesia, Philippines. I mean, there's been a real difference. That's been very noticeable. So you've seen that in terms of COVID, North Asia was faster and stricter in terms of the response. Vaccination rates were quicker, where South Asia was very different. So South Asia did initially lag. I mean, at this point, it's probably a bit more interesting, but there has been that real divergence. And so that has impacted the way we look at the region for investment. I would say, ultimately, I think that the transmission of inflation rates and all of those things that are going on in the US is going to be less severe. Actually, very, quite little impact, I would say, on Asia with everything going on. Now, the reason I say that, if you look at what's happened so far, is that bond yields in Asia haven't really done that much. FX has been quite stable. In fact, a number of North Asian countries, markets are showing a stronger performance versus the US dollar year to date. And I think inflation hasn't really picked up, particularly in North Asia. And of course, in places like India, it's been an issue for decades. But in North Asia, it's been very different. So there isn't the same kind of pressure. And Korea has already tightened. So Korea has done 50 basis points of rate rises in 2021. So I do think that we're in a very different scenario. So North Asia still for us is the favored market. We think that will, in terms of dividends and earnings, has a better outlook. But South Asia certainly looks better than it was previously. And the fact that the countries that were stressed previously, for example, Indonesia or India, in terms of current account surplus, foreign exchange reserves, and those kind of macro indicators, again, look far, far better. And that's why we think that Asia as a whole is far better positioned to cope with some of these moves that are going on now. Now, clearly the volatility you've seen in 2022 is, it tells you that the market wasn't quite ready for this. It's playing catch up. The market was behind the curve. And you look at Singapore with the MAS tightening this week, the inflation numbers from Australia being, again, higher than expectations. It tells you that the current volatility is the market adjusting to this new reality of what are going to be higher rates and liquidity being withdrawn. So central banks might act faster than we expect. And the market still has to take a bit more time to adjust this new tightening cycle. And the thing that's really at risk here, I think, are the more expensive growth names. And there's a lot of names out there that don't make much money. Some of them don't make any money. They are the ones that have been stressed so far, and they will continue to be so in this kind of environment. So I think that what has been ignored, and I guess I would say this is a value income manager, but it's really come to the fore this year with sectors as financials doing well, is that there's some very good quality value sectors in Asia where there's good dividend upside, there's good operational performance, and there's earnings growth, which you might not see in a lot of other sectors. So that's been overlooked, and I still think that is a very interesting area to be focused on in the first or second quarter of this year.
Thank you. And over to you, Ling. China being the outlier among the large economies with recent easing. Can you share your thoughts on that?
So on the China side, monetary policy is quite divergent with the global economies because what we had in China last year in 2021 was China actually tightening and coming to regulate industries. But this year, since December last year, at the Central Economic Work Conference, they focused on growth and ensuring there's stability in the economy. So what we've seen so far in January of this year are rate cuts and also the emphasis on making sure that credit is provided to the economy. So we expect more of this. We expect more monetary easing, more rate cuts, and better credit growth from here as well. So China is on a different path, it's on a path of its own. In terms of inflation and producer prices, we had problems last year where demand was strong as global economies reopened, but again, at the same time, supply was constrained because of China's decarbonization efforts where local governments were measured on the amount of carbon that they could reduce. This constrained a lot of supply in the materials sector. That's where some companies did very well because they could raise their prices. This year, we don't think it's happening. I think if anything, producer prices have peaked in China already towards the end of last year. Demand is weaker this year. Local governments are not tasked to ensure such tight enforcement of supply, production, and output. So I think you get better supply this year. You get an ease in producer prices. In terms of consumer prices, we've had fairly stable consumer prices for quite some time in China. There are no issues with core inflation. It's just slightly above 1%. And also in terms of wages, there's no pressure on wages, especially this year because there are a lot of layoffs in the education industry in China. Some of big tech is also reducing its workforce as well. And there's been a slump in construction activity. So there is no tightness in the labor force. There are no pressures on core inflation or food prices in China right now. So that's where China is in terms of monetary policy, quite different from the rest of the world.
So drilling down to the country, sectors, and company level, we've seen corporate earnings and dividend yields in Asia and Japan compare favorably against other regions. Is this a trend that we can expect to continue, and why? Where has this been the strongest, and which are laggards? Have there been some surprises along the way? And what are you anticipating in terms of earnings and growth set for 2022 and beyond?
Yeah, I mean, that's an interesting observation. I think the dividends in Asia have been just remarkable. If you look at what happened in 2020 with everything going on, dividends were hardly changed in Asia. So they fell barely at 5% in total. And I think that's an incredible result with everything going on. And that says a lot about the resilience of dividends in Asia, which is something we've been saying for a long time. But of course, you need a year like that to actually demonstrate the evidence. And there is the evidence that actually dividends in Asia have been resilient. They then came back strongly in 2021. I think the outlook, again, is very favorable. Now, there's never been an issue with companies in Asia paying dividends. It's been, the ability of companies to pay dividends is very strong. Cash on balance sheets at record highs, free cash flow is strong, CapEx cycle is coming off. I mean, there's a whole lot of reasons to be confident about dividends. But what's been the issue has been the willingness of companies to pay dividends. And that's been, Asian companies being more cautious. It's been, and think of 2020. I mean, if there's a year where you were going to be cautious, it would be 2020. And so companies did hold back. But still, relative to other regions, it was a very strong performance. And that says a lot about the attitude towards dividends in Asia. It says a lot about the balance sheets and the ability to pay dividends. So it says all those things. And so the outlook actually is very good. We are still seeing dividends coming through strongly. And sectors that did have some issues, for example, banks in Asia, or whether it's REITs, they've come back strongly as well. And financials and materials are surprising again. Materials in particular, huge dividends coming out of those sectors. And to answer your question, the stress really is on those sectors that haven't yet recovered. So, for example, Macau used to be a high dividend payer. They clearly are going to struggle to pay dividends. Airlines, leisure, some parts consumer. That will be some time in the future before they get back to where they were. But they were never really our key dividend payers anyway. So I think that it's not been a great impact, but one clearly has to watch out for some of these other sectors where it might be a couple of years before dividends return. But I would say generally, even though you see some derating, for example, in tech and so on, the actual operational ability of these companies to pay dividends, the earnings coming through, and for example, Taiwan Tech, is still quite strong. So they might derate, but it doesn't mean that they can't pay dividends. So I think there is very good reason to be optimistic on dividends in Asia.
Thank you very much for your insights. We've covered a huge amount here today, all the key topics. I hope you enjoyed this panel and you'll continue to watch our Global Media Week panels for further insights. Thank you all very much.